Welcome back. Oracle adjusted its revenue guidance, raised it, and also beat estimates in its most recent quarter, the fourth fiscal quarter for the company. This comes as the company's chief executive officer says cloud infrastructure revenue at the company should increase by more than 70% in fiscal 2026. Let's get more on all of this with Mark Moerdler. He's managing director of global software at Bernstein. Mark, thanks a lot for joining us. The market has been impressed with these numbers, impressed by the guidance raise as well. What do you think of Oracle's most recent quarter?
Look, it was a solid quarter, and what's really impressive is how aggressively the growth is accelerating. You just don't normally see something like that in a company this size. And so I think the setup is great.
I've spoken to one person already, one of your peers, another analyst, who thinks the revenue guidance is aggressive. Do you share that view?
We put out a note last October saying how they could hit their $104 billion target for 2029, which is they're in line with this, and they're doing better than what we had originally expected. So no, I think that they will hit the number, and it wouldn't surprise me at all if they beat it meaningfully.
You've got an outperform rating on the shares and a price target which has been increased just today to $225 US per share. That's up about $20 from the earlier price target. We're looking at the stock right now after a 9% increase in its share value, the share price this morning. It's now at 192. So why the outperform rating, and how do you get to that target of 225?
Sure. So the outperform rating is we believe that the whole cloud transition that Oracle has been in for a couple of years is going to drive accelerating revenue growth. The accelerating revenue growth is simple math. If you got a portion of the business that is becoming a bigger and bigger part of the overall company and growing significantly faster, your revenue has to accelerate. So we're looking at multiple years of revenue growth, and we believe they can deliver that with strong operating margins. So that's going to be above what you're going to see in most of the rest of software. Most of SaaS today is decelerating, and Oracle is accelerating. That's an outperform. In terms of the valuation, we do a price to forward earnings on 1 year's out EPS. But basically what we're doing is we're looking at the multiple and what they deserve, given the rate of growth that they're going to deliver. And we feel very comfortable with that multiple. And again, we wouldn't be surprised if they beat their guidance.
Okay, you do say in your note the lingering concern for you is the sustainability of OCI growth and RPO growth. First of all, unpack those acronyms for us. What is OCI and what is RPO? And explain why growth there is a concern.
Okay, so it's not mine as much as it is an overall industry concern. But OCI is Oracle Cloud Infrastructure Generation 2. It is what they call IaaS PaaS. It's similar in many ways, but very different from what Amazon AWS is, Microsoft Azure, Google GCP. It's the infrastructure you run cloud software in the cloud on. In terms of RPO, that's remaining performance obligation. So what the company gives you is a leading indicator of how much they booked that is not cancelable revenue that will convert into revenue over time. They give you current, which is 12 months, and then they give you RPO, which is the total contract value of everything. That RPO moved up in the 40s, and we've seen it consistently growing far faster than revenue. And well, again, contracts are getting longer. What that means is there's a lot of revenue that is in the pipeline, that is booked, that is contracted, that clients demand delivery of services, and that's going to drive the revenue growth.
Okay,
now,
go ahead, finish your thought.
Oh, sorry, I apologize. So why are people concerned? Look, it's unusual to see a cloud company accelerate this much, but it's tied to, we believe, the unique hardware and software architecture of what Oracle delivers. In addition, it's big numbers. And so people get worried when they see big numbers, especially when you look at that RPO number. But if you look at fundamentally what they do, they're differentiated from their peers, and therefore there are parts of the market where they're going to win. So we feel good about it. There are those that are concerned. I think that concern will abate over the next couple of quarters as the company consistently beats and raises.
What are we seeing among peers in the mega cap software sector? You make a reference in your most recent note that this is a market where so many software companies are slowing.
Right. So if you look at it, The cloud transition, the moving from workloads that ran in your data center to running in the cloud at some other provider, has been going on for over 20 years. Parts of the market have reached the point where most of the software is running in the cloud. That leads naturally to a deceleration in growth. So what you've seen companies like Salesforce, like Adobe, decelerate meaningfully over the last couple of years because portions of the market, or all of the market they play in, has seen some saturation. Snowflake is another example, MongoDB. And while they have continuing growth opportunities, it's a little more difficult. If you look at what Oracle does, Oracle's in parts of the market that are really early in the cloud transition, and they offer very unique capabilities, and the combination of that sets them up to win.